Hi everyone, today I want to talk Disney. Every Friday I do a deep dive analysis of one particular stock, and this week's stock is Disney. So Disney just released their earnings, and because their earnings were better than expected, they surged 10%. And this even caused some analysts to raise their price targets for the long term. And then I will go over exactly why the analysts are raising their targets. Despite the fact that their earnings were very low, they were better than expected because they were expected to lose money, but they were very low compared to their previous quarters. Next, let's talk about Disney theme parks and how they are losing money, but it seems to be okay. And Disney points out that their theme parks are currently running a net positive contribution. And lastly, I will go over the Morningstar report as well as their price predictions. As always, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like buying this 5-bed, 8-bath mansion in Las Vegas, or if you're just getting started on your financial journey, definitely like and subscribe. It has this long hallway for a living room with a hardwood floor on the ceiling. It has a very modern kitchen with all glass everything. It has a very large master bedroom with great views. It also has this thing for the stuff that it does, I guess. Yeah, I have no idea what this is. I don't know. Maybe it leads to this theater room, but probably not. It's currently on sale for $10.5 million. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. So Disney surged 10% as their streaming service prompts a pair of upgrades. Disney has become more aggressive with their streaming service, obviously because the Rona is hurting all of their other businesses. And the largest effect is Disney theme parks. Following the earnings report, it traded up 10%, which caused this analyst to up their rating from $123 a share to $140 per share. They also announced that Mulan would be going direct to consumer on September 4th, avoiding the traditional theater disruptions due to the Rona. They say the bottom line is, the burden of proof is to say why Disney won't be the sector leader in streaming services versus why they will be, meaning that they believe Disney has a clear advantage in the future of streaming. And as the CEO pursues more and more opportunities in streaming, another analyst upgraded the stock to outperform from neutral, meaning that they expect it to outperform the S&P 500, at least in the near future. Year to date, Disney has gained 27%, versus the S&P 500, which is at 16%. Moving on to Disney stock surges after earnings, and it's all because of a bet on their streaming service. They say Disney is not sitting on their hands during the Rona, and they continue to add subscribers to their media entertainment company. Disney received the praise of several Wall Street analysts, despite a brutal quarterly earnings report. Disney shares tumbled on a 42% drop in revenue, which resulted from the closing of theaters and the suspension of the sports season and a shutdown to all of their theme parks. However, the streaming service made its debut in November and added millions of subscribers in that quarter, reaching 6.5 million worldwide by August 3rd. They plan to continue to expand the streaming service, including ABC, FX, and other Disney properties similar to Hulu in the United States. Disney also said they will release the twice-delayed live action of Mulan on Disney Plus for subscribers on September 4th. It will cost $30 in the United States, and we expect Disney's management to comment on this further on Investor Day. They say it's been a challenging year for Disney. However, the company continues to surprise us. They plan to expand with the launch of Star next year, and we expect a slow but real recovery for the legacy business, which pushes their price target to $135 per share. The CEO has been taking innovative and bold steps to further the streaming service and has become more and more aggressive, and they also expect they will recover from the Rona. Another analyst said they are moving it to a buy from a hold, again mentioning the streaming service as well as the stable of Marvel, Pixar, Star Wars, and other namesake franchises that can't be beat. That same analyst mentions the fact that Disney intellectual property puts them far ahead of their competitors and opens a path to more appreciation. They do mention a little bit of the bear case here, saying that the Rona continues to linger and that the global economic factors could delay the eventual recovery from Disney. However, due to the upgrades, 64% of analysts view Disney as a buy or the equivalent versus the 52% before the report. The average price target is at $132 per share, which is currently a 4% growth from the $127 a share from last Wednesday. Moving on to Disney parks being closed, it's not likely that you associate a $1.96 billion loss with an ultimately swimmingly performance. Despite that, Disney continues to mention that this is a positive contribution. They lost 85% on their year-over-year revenues. However, Disney turned this into a positive. They continue on saying that success is relative, and Disney points out that its theme parks are running a net positive contribution, meaning that revenue is exceeding their variable costs. Of course, this is great news, considering that most people assume that the Rona is causing Disney to lose money. Closing down a theme park does not mean it's not losing money. There are plenty of costs, both out of pocket and accounting, that go into a closed attraction. The simple fact that these parks are not losing money is much better than expected. Both Disney and Comcast parks are not going to be profitable for a long time, but staying open right now and generating enough income to cover costs is better than nothing, especially during the Rona. In the next 3 months, we look forward to finding out whether Disney can close this $1.96 billion deficit, and some of this revenue may come from Shanghai or Hong Kong, where Disney has a partial stake in those Disney-branded parks. As the hole shrinks, Disney's profitability will go up. Of course, this does not mean that the recovery will be quick. There will be bumps along the road, like pass holders who are frustrated because they were not able to use the parks during their past term. However, these people will either re-up or they will be replaced by new visitors as Comcast and Disney search for a new form of normalcy. Moving on to the Morningstar report, they still give it 3 stars and a fair value of $127 per share, which is a little bit lower than some of the other analysts that I mentioned before. They used to have a 1.5% dividend, but of course they cut their dividend during the Rona in order to save money to ensure that they will weather the storm. So for right now, they think Disney is on the low end of fair valued, and they still give them a hold rating despite the better than expected earnings. Moving on to the bull case, parks and resorts have rebounded strongly, and the opening of Disney Shanghai will provide additional momentum. The addition of the Star Wars franchise broadens the demographic that the company can address, and additionally, the strong distribution of merchandise should help speed the monetization. Although making movies can be a hit or miss business, Disney's library of content have been very popular, and this reduces their volatility over time. Moving on to the bear case, they say the business model for the media networks depends on continued growth of retransmission and reverse compensation fees, and the slowdown of growth of these fees would potentially hurt the business. The increased cost of certain popular programming, such as sports on ESPN and ABC, could affect their margins, and developing a mass market hit program could be unpredictable, especially in the media fragmentation continues. Moving on to Morningstar's price predictions, you can see here they expect a price of around $144 by the end of 2021, which makes it a little bit strange since they're saying that Disney is currently fairly valued. But despite that, they still show significant upside. So to summarize, Disney has kept themselves afloat with their streaming service, and they plan to expand on their streaming service into the future. They also will do some movies direct to consumer, which will allow them to maintain their movie production profits. Their parks continue to have a rocky road ahead. However, they are currently not losing the company money. And because of all of that, they were able to turn a very small profit in Q2 when they were expected to lose a fairly significant amount of money. And because of that, I am currently bullish on Disney. Let me know down in the comments section what you think of Disney and what your current positions are. Definitely like and subscribe if you got any value out of this video. Of course, this is not financial advice. This is all for entertainment purposes. And with that, let's get to the jelly. So today's jelly is the Californians from Saturday Night Live. However, this is a compilation of them falling out of character. So here's what that looks like.
The Californians.
I think you should get home now, Devin.
There's nothing going on, Stuart.
I said go home. Get back on San Vicente, take it to the 10, then switch to the 4, 4 and 5, north, and then to Milan, where you belong.
At this time of day, it's gonna be jammed. Are you crazy?
Just get on the 10 and get out of here. It's almost Long Beach.
Look at me. You can do this. I know a shortcut through El Segundo.
And then I told the driver, like, yo, hang a ride on Alhambra and drop me off on Sunset, man.
Back in Wango.
Yeah, it's right by his bungalow.
Well, let's sit down in Sequoia seating arrangement. Her name's September. Oh no. That really complicates my life. You guys, I'm so happy that the whole family can be the whole family can be together for Thanksgiving. Plus, my dear friend Trey. And everyone, just help yourself to some dried
The landscape company sent me to trim back your rosemary tomatoes. Now, is it okay if I use your upstairs bathroom, the one across from Russell's room?
Wait. How do you know where Rose's room is? Devin? Brad? What did I just see going on here?
I don't know, Stuart. I'm not confused.
Karina and I need to peel in.
What if I'm just quiet?
Why did you come back? You belong here with me in Southern California.
Clearly, they have a lot of fun filming these, and it makes it very difficult for them to stay in character. And actually, I think this is more funny than the original Saturday Night Live skit. Them breaking character kind of makes it more funny for me. Anyway, let me know down in the comments section what you think. Definitely like and subscribe before you go, and have a great day.